Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to roll through Twitter, look at, I think there's some real estate stuff, commodities, also look at the overall financial markets. I can't remember if there's anything interest rate related or not, but we're going to look at some of that stuff. We're going to go over it. I'm going to interject my financial opinions all around this. And if you guys like this type of stuff, if you want to learn more about the markets, you can obviously sign up for finding-value.com. All right, so let's dive in here. And if you want to follow me on Twitter, it's at finding_finance. So Bitcoin cycles follow macro cycles, always have. Was a pleasure joining yesterday. So kind of an interesting chart, and I like looking at everything. It says Bitcoin cycles follow macro cycles versus the manufacturing PMI. So this is the manufacturing PMI. This is the cycle of Bitcoin. And just kind of interesting to see how these things are somewhat correlated. Next, we've got the nested equity isn't even the best part of the housing data. It's all about debt structures and credit channels. That is why we had a massive sales crash last year and only a little inventory was created. No credit boom, no credit bust, them the rules. So US homeowner equity surges to over 30 trillion as the value of the housing stock passes 43 trillion. And this is your mortgage debt outstanding. You can see we didn't have a lot of mortgage debt come online in the 2010, 2011, 2012, all the way even recently. It really hasn't budged that much. We had a massive boom from 2000 all the way up to 2008 for mortgage debt outstanding. You can see where this peaked here in that 06, 07. And then we got into trouble in 08 when the homeowner's equity declined and the debt stayed solid. So that is interesting. Charlie Munger, spend less than you earn and invest smartly, and you will be successful. Americans, hold my beer. 1 trillion in credit card debt later. From 2022, 5/2022 till now, 1 trillion in credit card debt in 1 year. That's crazy, guys. That's just crazy. It says nearly every rate hiking cycle has ended in a recession. Hard to imagine this time will be any different. I think we're most related to 99, 2000 and that recession that came in 01, 02. And I think the tech sector is definitely feeling it. The increasing interest rates is going to hit the tech sector, I think, the hardest. That's my take. Always wonder how many people saying housing is way dramatically overpriced have ever, in fact, tried to go build housing. I just think some of these are funny. A lot of people they just talk so much on Twitter, and I read all these things, and it's like, man, a lot of people. I don't know if they know a lot, if they have done this stuff. And when I read this, it's like, yeah, it's pretty much true. All these people say, yeah, it's dramatically overpriced. Like, go try building one. go figure out how hard it is to build a house. Transitory. Boy, how the Fed must feel now. Is it me or did nearly everyone realize but them? This is the U.S. interest rate hikes. The rates have risen faster than any other time in recent history. How did they I don't understand how they did this. I really don't. I mean, obviously they printed a bunch of money. The stimulus money created probably a good portion of this, and well, it's probably the majority of the inflation in the system. But why would they say it's transitory? Why would they come out and say they weren't going to raise rates till 2024? They weren't even thinking about raising rates, if I can remember is what they said. And here we are with the rates have risen faster than any other time in recent history. How is that possible? How did they get it that wrong? Or did they do this on purpose? I don't know. I mean, they can't be that bad, can they? I mean, this is, I don't know. This just dumbfounds me. I mean, I don't know. That's where I got there. Record outflows of U.S. bank deposits. This is interesting, guys. Look at The bank deposits from them printing the money, which they deposited in the banks, and then look at it just reverse and go straight lower the entire way. And I don't think the banking crisis is helping at all. And this is the deepest contraction ever in terms of deposits for all commercial banks. Now, I want to read this. This is an interesting thing that somebody had written. It also, I would say, is evidence or some evidence that I see in the markets as well of the people who cannot buy homes, but they have a lot of money and they've actually saved and done everything right. So he says, I feel so helpless. I did everything right. I picked a high paying degree, engineering, to pursue right out of high school. Studied at university from 17 to 22, graduated last year and landed a high paying job right out of university. Base salary of 75,000, total compensation of 100. I amassed 150,000 plus in savings through various internships, co-ops, side hustles during undergrad. I have $30,000 in debt. I am 24 and male. Zero financial help from parents, yet I am unable to buy a normal house in my hometown. If I was born 3 to 4 years earlier and in my current financial position, I could have bought any house in my area. Bank is only pre-approving me up to purchase price of 500K. I know the general advice is just move further from GTA or get a cosigner, but these shouldn't be the solutions. Housing should be affordable to the top 10% earners in Canada at the very minimum in GTA. This country is messed up. You know, we've got a lot of people here in America. I think this is Canada here. Toronto real estate is what it says. We have a lot of people here in America that they're holding off on buying homes because they're like, the house prices are too high. But they earn quite a bit of money. They've saved quite a bit of money, and they're just delaying their home purchase. The problem, at least in America, one of the problems, is we're underbuilt in real estate, and two, we've got a large demographic all wanting to buy homes all at the same time. It's that simple. It is that simple. Yes, home prices could pull back a little bit if people get scared or if there's a recession or if the banks stop lending. Yes, I agree. But overall, the market's it's going to go higher if they lower interest rates. They can slow it down, and they're using interest rates to slow it down. If they want to continue to slow the housing market down, they're going to have to keep interest rates high. And that's why Powell keeps saying higher for longer, because it has to. It's the only way you can slow it down. He lowers interest rates, and all these guys who can buy homes, they're gonna buy homes. So this guy said, I'm sorry, it's not true. Home prices was flat. He's talking about inflation-adjusted home prices. I made a post. I said home prices went up in the 1970s along with interest rates. I also said that unemployment went up during that same time frame. A lot of people talk about interest rates going up and home prices going down. That is not what we see in history. It is almost always that interest rates go up alongside home prices. Then home prices will get into a hypersupply phase. The interest rates generally go sideways. They hold them sideways. Then home prices fall and interest rates fall together. That is the cycle for the most part. But here's the inflation rate and the home price going up. If you click it, they have an average of 9 and 9. But I will say this, home prices are a large driver of that inflation rate. It says, yes, friends, home prices are inching up on tight inventory. Despite affordability challenges, though 2 of 3 Altus price measures are down year over year, the weekly is improving. Inventory actually declined this week to 419,000 single-family homes. There it is on a weekly basis. Still very low inventory. This is 2019 in the blue up here, 2018. Says Zillow and Black Knight both reporting this morning that home prices rose in April. All year, the Twitter trolls have been calling me a liar as I reported the market turning. I'm still so sensitive to the personal insults. So he's got here, Market Sniper, potential for anti-fiats to skid off a little short-term macro bull, some after a lengthy period of strength. This can affect crypto, gold, etc. I expect a CPI beat on Wednesday, validation for more, for longer rates. Gold chart below, and community Litecoin short. Yeah, we do get some wicks on the top here. We could see a pullback in gold for a short period of time. Definitely agree there. And this is Litecoin Tether. I don't really follow this, but this looks really bad. This is stair stepping lower. Big hit on the head. It's very hard for this to go higher. You can see all the small red or small green candlesticks. Hit on its head. It just can't go up. Hit on its head. Hit on its head. It's just stair stepping lower. At least that's what I call it. This is U.S. oil and gas companies have officially begun to reduce their number of operating rigs. First 5-month contraction since 2020. These businesses are in no hurry to increase production in a market where the supply remains incredibly limited. In fact, oil production is still 6% lower than pre-pandemic levels. If anything, the overall tightening of monetary conditions and the recent price volatility in energy commodities are severely affecting the capability of these companies to expand their resources. So U.S. total operating oil and gas rigs are down. Down, down, down. So let's pull back on our production and supply, and we'll see what happens this summer with demand in both natural gas and in oil. I'm very interested to see where our inventory levels go. So here's SWU. SWU is what Justin was talking about and the pricing of SWU. This is SWU versus U308. That is uranium. What happens next for uranium? U308 price hopefully happens this year thanks to this. So this is SWU. The average SWU price is going vertical here since 2020. 2022, it really took off. The uranium price it's moving up, but it's lagging behind. So this is SWU price up here, rocketing higher from 2001 all the way till 04, 05. And this is uranium coming behind it. So there is a correlation here to some degree. It's loosely correlated, or no, these are pretty tightly correlated. It's just lagged behind it to some degree. And hopefully that's the case. Hopefully we get a big move in the physical uranium price coming up here. We have, until you can manage your emotions, don't expect to manage money. Here's a cool chart. He says, Fed would probably save the bond market before the US dollar, but the debt mountain could take down bonds anyway. This chart means could see rate pause cut phase next, followed by hiked rates, cause of second inflationary wave. Then we'll see if the yield curve control is a usable tool or not. This is TLT monthly, putting in a bearish shoulder head shoulder potentially, and the big move in interest rates moving on higher for the 30-year. Now the 30-year just broke to the upside of its little move here, so we could see it go up immediately. He's looking at the 20-year yield, but the 30-year yield broke out to the upside. Today it did. So that is interesting. But that's what I've got for today, guys. We can end it there. Lots of real estate in this one. I know some people don't really like real estate, but I look at it. I like it. I think it's useful information because that is a driver of credit expansion. But that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you haven't already. We have a 7 a.m. Mountain Standard Time Saturday question and answer session coming up this weekend. See you there. Catch you next time. This is Finding Value.